Imagine suing a company for 105 million ringgit, right? You spend all the time, the resources, you actually win a decisive victory in court, and then you realize you might not get a single cent of that judgment.
Yeah, it's a nightmare scenario.
Right. The gavel bangs, the judge sides with you, but, well, the bank account stays completely empty. And that is the exact paradoxical nightmare that's currently facing one of Malaysia's largest industrial landlords.
It really is.
Welcome back to the Deep Dive. If you're joining us today, do us a quick favor right off the bat, hit that like button and subscribe to the YouTube channel. It tells the algorithm you value this kind of, unvarnished financial analysis, and it helps us keep dissecting the companies you care about.
And today's subject is certainly one that requires a scalpel. We are returning to AXIS Real Estate Investment Trust, which most of you know as AXIS REIT.
Yeah, a giant in the space.
Exactly. This is a massive entity in the Malaysian industrial and logistics property sector. I mean, historically, they've been lauded for really proactive management and just relentless acquisition-driven growth.
Right, and for those of you who have been following our evolutionary journey tracking this specific stock, we've been pulling the thread on AXIS REIT for quite a while now.
We really have.
I mean, we did that comprehensive deep dive on their Q3 2025 numbers where we highlighted this massive profit surge, but, and this is key, we also flagged that looming 105 million ringgit lawsuit and their incredibly heavy debt load.
Yeah, that was a huge red flag even back then.
Right. And then in our Q4 2025 review, we actually explicitly asked the question, is this still a safe REIT going into 2026? Because we started spotting these hidden structural risks.
Which is why earlier this year, looking at Q1 and Q2 of 2025, we were practically issuing warnings about their underlying cash flows, even though, they were managing to show dividend growth at the time.
It's been a fascinating timeline to track. So the core mission of today's deep dive is to take their freshly released Q2 2026 report and just finally answer this burning question. Have those structural risks we've been talking about for 18 months finally caught up to AXIS REIT? Or, is this industrial giant just experiencing a temporary speed bump?
Well, the numbers in this Q2 2026 report card are, frankly, they're a reflection of a moat under significant stress.
Okay, let's unpack this. What are we looking at?
Let's start with the top line. So, total trust income for Q2 came in at 88.8 million ringgit. That actually represents a fall of 2.3% quarter-on-quarter and a 1.6% drop compared to the exact same quarter last year.
A drop in top-line revenue for a REIT is usually the very first alarm bell because, their revenue is contractually locked in via leases, right? It shouldn't fluctuate downward unless something is actively breaking.
Exactly. But the bottom line took a substantially harder hit. Realized net income, which, is the crucial metric here because it represents the actual distributable cash profit generated from operations that dropped 7.8% quarter-on-quarter, down to 46.9 million ringgit.
Wow.
Yeah, and year-on-year, we are looking at a 9.9% drop. And you have to remember, because real estate investment trusts are mandated to pay out the vast majority of their earnings, when that realized net income falls, the payouts to the unit holders fall right along with it.
In perfect lockstep.
Right. So earnings per unit dropped to 2.32 sen, and consequently, the distribution per unit, the DPU, fell to 2.3 euro sen.
I really want to provide some crucial context on that 2.30 cent figure for you listening. Because, a fraction of a sen might not sound like a systemic issue in isolation, but if we zoom out, if we look at the trajectory, it paints a stark picture.
It really does.
Just one quarter ago, right, in Q1 2026, the DPU is 2.50 sen. If we look exactly a year ago, back in Q2 2025, they were paying out 2.65 sen. That is a very distinct compounding downward trend.
Yeah.
So what is the actual mechanism driving that?
Well, the mechanism is a pretty brutal combination, two opposing forces. You've got contracting revenue, and you've got expanding operational costs. The most revealing metric in this entire report is their net property income margin, or NPI margin.
Right, which measures how efficiently management turns gross rent into actual profit.
Exactly, before debt and administrative costs. And that margin compressed all the way down to 85.1%.
So I see the margin compression, but I'm trying to understand the physical reality behind it. Like, what is physically eating the cash at the property level?
So property expenses just spiked. They went up by 9.9% quarter-on-quarter, hitting 13.46 million ringgit for Q2 alone. And the management's commentary, they attribute this to higher, quote, one-off maintenance costs, specifically pointing to severe ground settlement issues and leakages.
Ground settlement issues. Let's pause on that. Because that phrasing sounds deceptively benign, right? Like fixing a leaky faucet in your kitchen. But in the context of massive industrial and logistics warehousing, ground settlement is an engineering nightmare.
Oh, absolutely. It's a huge deal.
We are talking about facilities that house, like, heavy manufacturing equipment, massive racking systems, constant forklift traffic. If the concrete slab floor starts settling or cracking because the soil underneath is compacting, you can't just patch it. You are talking about bringing in structural engineers, injecting specialized foam or concrete beneath the foundation, and completely disrupting the tenant's operations.
I would actually take that a step further, to be honest. It's not just the direct cost of the repair, which, as you said, is exorbitant. It's the secondary effect on the tenant relationship.
Right.
Because in industrial real estate, floor load capacity and absolute levelness are mission critical. If a tenant is using automated guided vehicles or high-density vertical racking, a floor that is off by even a few degrees due to settlement renders the entire facility unusable.
Wow. Yeah, that's completely debilitating.
Fixing this requires massive capital expenditure that you simply cannot easily pass on to the tenant.
I'm thinking about an analogy for this. For years, I think the market has treated AXIS REIT like this massive, unstoppable commercial freight train. It just hauls heavy cargo along a smooth, predictable track, delivering steady dividends at every single station.
That's a good way to look at it.
But suddenly, it's like two of the train cars are completely empty, and the engine itself needs unexpected, highly expensive suspension work. The train isn't derailed, it's not going to the scrapyard, but the maintenance bill is just eating the profit margin of the entire journey. Does a ground settlement issue of this magnitude suggest that their 70 property portfolio is simply aging out of its prime?
I mean, that is the multi-million ringgit question right there. When a REIT scales to 70 properties, statistical probability dictates that maintenance cycles will eventually overlap. Many of their foundational assets are legacy properties.
Right, they aren't brand new.
Exactly. They aren't the brand new, ultra-modern, green-certified logistics hubs being built today. The freight train metaphor works perfectly because the underlying framework of the business is intact, but the operational ride is getting violently bumpy. And smoothing out those tracks requires immediate cash that would otherwise be flowing straight to the shareholders.
But the maintenance bill is really only half the crisis here. Because if we go back to the top line, the revenue is actively shrinking. A REIT's lifeblood is organic rental income. If rent is dropping, it means square footage is sitting empty. So we need to talk about the vacancy problem because the occupancy numbers in this Q2 report are striking.
Striking is definitely the right word. Average portfolio occupancy has dropped to 93%. Now, I know in the broader commercial real estate world, like office or retail, a 93% occupancy rate might seem perfectly healthy.
Yeah, but in the industrial REIT world, 93% is a massive leak in the hull of the boat, especially considering that AXIS REIT was sitting at a very comfortable 97% occupancy just a year ago. A 4% drop across the multi-billion ringgit industrial portfolio equates to a massive amount of missing monthly cash flow. So where is this bleed actually coming from?
Well, the vacancy bleed is highly localized. It is heavily concentrated in two specific prime logistics assets. The first is the Bukit Raja Distribution Center. Its master lease expired back in Q4 of 2025, and currently it is sitting at a dismal 58% occupancy.
Ouch.
Yeah. And the second major culprit is AXIS Shah Alum Distribution Center 3. That lease expired in Q1 of 2026, and it is currently sitting at just 49% occupancy.
Wow. So you essentially have two massive logistics assets sitting roughly half empty. And I think it's important for you listening to understand the mechanics of re-tenanting industrial space. When a huge logistics tenant moves out of a distribution center, is nothing like a residential apartment where you throw on a fresh coat of paint and move a new family in the next weekend.
Not at all. It takes months, sometimes quarters.
Right. Supply chain companies plan their logistics networks years in advance. They have incredibly specific requirements for loading bay ratios, power draw, ceiling heights. It's a highly illiquid leasing market. But there is a third culprit eating into the revenue, isn't there? And this one wasn't just a tenant choosing not to renew a lease.
No, this third issue was an unforeseen operational disaster. In February of 2026, there was a major fire at Wisma Kemajuan. And because of the extent of the fire and the subsequent structural and smoke damage, there has been a complete and total suspension of rental income from that specific property.
A complete suspension. So the tenant can't operate and AXIS REIT can't collect rent. Now, the immediate reaction of any seasoned investor is to ask about insurance. I mean, commercial properties of this scale are heavily insured.
And they are. Management has been very transparent in their filings that X-REIT holds comprehensive insurance policies. And these policies cover not only the physical rebuilding and remediation of Wisma Kemajuan, but crucially, they include a business interruption clause that covers up to 24 months of lost rental income.
Okay, so if they are covered for the rebuild and the lost rent, is this just a non-issue? The insurance company writes a check, they get the building back, and they get the lost rent. No harm, no foul, right?
Well, I would definitely push back on the idea of no harm. I mean, in the long run, yes, they are mathematically made whole. But in the short term, this introduces a brutal accounting and cash flow mismatch.
How so?
Under the prevailing accounting standards, specifically how contingent assets are handled, a company cannot officially recognize that insurance cash on their income statement until the claim is virtually certain and finalized by the adjusters. So while the money is theoretically coming in the future, it cannot be booked as revenue today.
Which means the balance sheet is starving today, even if there is a massive feast promised for tomorrow.
Precisely. It is a timing mismatch, not a permanent destruction of value. The insurance cash won't hit the books until late 2026 at the earliest. And, we see the same timing mismatch with the vacant distribution centers. Management is actively guiding that they have secured new tenancies. They're projecting that the Bukit Raja facility will recover to 91% occupancy and Shah Alam will hit 100%.
But those leases don't commence immediately.
No, they don't start generating cash until January 2027.
So if you are listening to this and you're holding this stock, relying on that dividend today, this is where the rubber meets the road. The promise of an insurance payout in December or full occupancy next January does absolutely nothing for your immediate quarterly cash flow. Your dividend was just cut to 2.3%. You cannot pay your mortgage today with management's guided forecast for 2027.
That's a painful reality for income investors.
So the question becomes, how much grace should the market give management for these so-called timing issues?
I think the amount of grace an investor affords is directly proportional to their trust in management's execution history. A 6 to 12-month vacancy period, combined with a delayed insurance payout, places an immense strain on a REIT's operating liquidity. It forces attention. Do they slash the dividend further to preserve cash, or do they take on expensive short-term revolving debt just to artificially maintain the payout yield while they wait for the new leases to kick in?
And historically, AXIS REIT's management has had a very strong track record of execution, which is why they generally get the benefit of the doubt. But while the fire at Wisma Kemajuan is a temporary physical setback and the Bukit Raja vacancies are a temporary leasing setback, AXIS REIT is currently battling a massive, potentially permanent financial setback in the courtroom.
Yes, the Yong Nam situation.
We have to dive into the Yong Nam legal battle because this is the hook we started the show with, and it is just a fascinating case study in legal reality versus financial reality.
It is the absolute definition of a Pyrrhic victory. I mean, we flagged this 105 million ringgit lawsuit in our Q3 2025 deep dive. At that time, it was sort of a looming shadow on the balance sheet. But now, as of this Q2 2026 report, the situation has dramatically evolved. It has metastasized from a theoretical victory on a legal document into a practical, real-world nightmare.
Let's lay the groundwork for you listening so we all understand exactly what is at stake here. AXIS REIT is suing a former tenant, Yong Nam Engineering, along with his corporate guarantor, Yong Nam Holdings. They are suing for unpaid past rent, but more importantly, they are suing for liquidated damages representing the unexpired portion of the lease.
Right, because this tenant was supposed to be locked in all the way through December 2029.
Exactly. So the total claim AXIS REIT filed was for over 105 million ringgit.
To contextualize the sheer gravity of that number, AXIS REIT's total realized net profit for the entire first half of 2026 was 96.8 million ringgit. So this single lawsuit represents more than 6 months of pure profit for their entire 70-property portfolio.
It's massive. And AXIS REIT technically won the first round of this fight. They were awarded a judgment in default by the courts because Yong Nam basically failed to effectively mount a defense. So AXIS REIT has a piece of paper from a judge saying Yong Nam owes them 105 million ring. But, and here's the critical Q2 2026 update that changes everything. Both of the Yong Nam entities went into official liquidation. They are bankrupt.
Which changes the game entirely.
Right. Dealing with a bankrupt company is an entirely different universe than dealing with a struggling one. Walk us through the mechanics of this liquidation process, because I think a lot of people assume a court judgment guarantees payment.
Yeah, that assumption is the most dangerous trap in corporate litigation. When a company enters liquidation, control is stripped from the directors and handed over to an independent liquidator. The liquidator's sole legal duty is to gather whatever assets are left, sell them off, and distribute the scraps to the creditors according to a very strict legal hierarchy. So X-REIT had to submit what is called a proof of debt to this liquidator to claim their 105 million ringgit.
And what did the liquidator say?
Well, in May 2026, the liquidator formally reviewed the claim. They admitted the portion of the claim for the rent that was already past due, about 44.4 million ringgit. But they outright rejected 82.7 million ringgit of X-REIT's claim. With the stroke of a pen, they wiped out 82 million ringgit of X-REIT's legal victory.
Wait, I have to stop you there. So a judge rules in X-REIT's favor, but an appointed liquidator can just cross off 82 million ringgit of a court-mandated judgment. How is that legally possible? What is the mechanic that gives the liquidator that kind of power?
It comes down to the nature of the debt and the hierarchy of insolvency law. The rejected 82.7 million represents the liquidated damages for the unexpired term of the lease. It is the theoretical future rent from late 2024 all the way to 2029. Liquidators operate under a principle of preserving the remaining pool of capital for secured creditors and immediate tangible debts.
Right, the money that's actually owed right now.
Exactly. From a liquidator's perspective, recognizing an 82 million ringgit claim for future rent on a building that Yong Nam isn't even occupying anymore heavily dilutes the pool of money for everyone else, like the banks, the secured bondholders, and unpaid employees. Insolvency law often subordinates claims for future speculative damages.
That is brutal. It's essentially the liquidator saying, hey, you can mitigate your own losses by finding new tenant for the next 5 years, so we aren't going to let you drain the remaining cash from actual secured creditors just because you have a broken contract. So obviously, AXIS REIT fought back against this rejection.
They did the only thing they could do. In June 2026, the trustee for X-REIT filed a formal court application to reverse or vary the liquidator's decision. They submitted their supporting affidavits in July, and the court has set a formal hearing date for late October 2026 to argue the merits of the liquidator's rejection.
This is the exact scenario I was talking about at the start of the show. You spend the money on the lawyers, you win the massive settlement, you feel totally vindicated, the judge bangs the gavel. But then you go to collect, and you find out the entity you sued is a hollow shell, and the liquidator is actively blocking your access to whatever pennies are left inside. The fancy piece of paper says you won, but your wallet is still completely empty.
That is the harsh reality of being an unsecured creditor. Even if the court sides with X-REIT in October and forces the liquidator to legally recognize the full 105 million ringgit claim, it does not mean X-REIT gets a check for 105 million.
It just means their slice of the pie is recognized.
Right, it just means their slice of the bankruptcy pie gets larger. But if the pie itself is only worth 5 cents on the dollar, a larger slice is still essentially worthless. Landlords are typically unsecured creditors. They are at the very back of the line behind the tax authorities, the employees, and the secured lenders. The rejection of that 82.7 million is a catastrophic blow to the potential recovery value, and honestly, investors need to mentally write that money off.
It is a massive, bitter pill to swallow. So if we synthesize all of this, the operational dip with the MPI margin compression from the ground settlement issues, the bleeding vacancies at Bukit Raja and Shah, the physical fire at Wisma Kemajuan, and this escalating paradoxical legal nightmare with Yong Nam, we have to step back and update our ultimate judgment metric. For those who track our coverage, it's time for the Financial Moat Scorecard.
Right, and for listeners new to our analytical framework, the Financial Moat Scorecard is how we evaluate a company's structural defensive strength. A wide moat means the company has the pricing power, the scale, and the captive audience to defend its profitability against macroeconomic headwinds, aggressive competition, and, well, the kind of localized operational disasters we've just discussed.
In our Q4 2025 deep dive, we gave X-REIT a very solid 7 out of 10. They had a strong, defensible fortress. So where do they sit right now, factoring in everything from this Q2 2026 report?
We are issuing a formal downgrade. The new financial moat score for X-REIT is 6.5 out of 10.
A 6.5. So, a downgrade, but realistically still a passing grade. Given the sheer volume of fires they're actively putting out, both literally and metaphorically, why didn't the score drop lower? I mean, why not a 5?
The nuance here is really crucial. It remains a 6.5 because the core structural foundation of the company's business model hasn't permanently broken. X-REIT remains a dominant, entrenched leader in the Malaysian industrial space. They still operate 70 properties. A vast majority of those properties are performing perfectly well, generating steady yields.
So the scale is saving them.
Exactly. Their moat is built on sheer scale, strategic geographical location, and the high switching costs for industrial tenants. Logistics properties remain incredibly relevant and highly demanded in the current supply chain economy.
I see your point, but the walls of that fortress are undeniably taking some heavy artillery fire right now.
Absolutely, and that is exactly what the downgrade to 6.5 reflects. It's acute operational softness. The moat is being severely tested. When your realized net profit drops nearly 10% year on year, when your portfolio occupancy slips 400 basis points down to 93%, and when you are mired in a highly uncertain, drawn-out liquidation battle over a massive broken lease, the fortress walls are visibly chipping. Management's ability to maintain this 6.5 score, let alone rebuild it to a 7, relies entirely on flawless execution over the next 6 months. They have to lease up those empty distribution centers exactly on the timeline they promised to the market.
Let me act as the proxy for the listener here, because I really want to make sure we are calibrating the risk correctly. Does a downgrade to a 6.5 suggest that a retail investor should hit the panic button? Should they be liquidating their positions today because the moat is breached and the castle is falling?
No, I would strongly caution against classifying this as a panic button scenario. We categorize this as a severe localized dip rather than a systemic structural collapse. A systemic collapse in a REIT would look like mass tenant defaults across multiple different sectors, a collapse in overall market rental rates, or a fundamental inability to service their debt obligations.
Right, which we aren't seeing.
What we are seeing with AXIS REIT are isolated, albeit severe, issues. A specific fire, specific lease expirations at 2 properties, one specific bankrupt tenant. But it does unequivocally mean the margin of safety for the investor is much thinner today than it was a year ago.
Okay, so if the operational moat is slightly weakened, but not destroyed, we have to look deeper into the bedrock. Because a REIT cannot survive on rent collection alone, right? It lives and dies by how it manages its capital structure, how it handles debt, how it navigates tax policy, and how it raises equity. Let's pivot to the capital structure because there's some massive numbers and some serious red flags here.
Let's start by looking at the debt profile. Total financing for AXIS REIT currently sits at approximately 1.8 billion ringgit.
1.8 billion ringgit. That is a staggering amount of leverage.
It is, but in the REIT sector, leverage is part of the design. That 1.8 billion is split between roughly 616.7 million in short-term financing and 1.23 billion in long-term financing. This gives them an overall financing ratio, commonly known as gearing, of around 73.76%.
Let's contextualize that 33.76% for the listener, because that figure is actually comfortably below the regulatory limit set for Malaysian REITs, which is typically capped at 50%. So from a purely regulatory standpoint, they aren't maxed out on the corporate credit card. But we need to talk about the composition of that debt, because 616 million ringgit in short-term debt is not a trivial amount of money. That is debt that matures quickly and needs to either be paid off entirely or rolled over into new loans. In a macroeconomic environment where interest rates have remained stubbornly high, rolling over 500 million ringgit of short-term debt usually means accepting a much higher interest rate on the new loan, which of course directly eats into the distributable profit.
And that impending debt rollover leads us directly to their current equity strategy, which is where things get highly contentious for existing shareholders. AXIS REIT recently secured a renewed mandate from their unit holders to issue private placements of up to 20% of its total fund size.
We really need to walk the listener through the actual mechanics and mathematics of a private placement, because it is a massive deal that directly impacts their portfolio. Essentially, the management has been given the permission to create brand new shares out of thin air, up to 20% of the total number of shares that currently exist, and sell those new shares to private institutional investors to raise a massive pile of cash.
That is the exact mechanism. The primary stated goal by management for this placement mandate is to de-gear, which means they intend to use the cash raised from selling these new units to pay down a chunk of that massive 1.8 billion ringgit debt pile.
Right.
By paying down debt, they lower their interest expense and make the overall balance sheet mathematically safer. It also creates debt headroom, meaning they have the capacity to borrow more money later if a lucrative acquisition target appears.
But this is where the math gets brutal for the retail listener holding the stock today. Let's say you own a slice of this company. If management issues 20% more shares to external funds, the total pie just got 20% larger, but your specific slice stayed the exact same size. Your ownership percentage just got diluted. Even if the total net profit of AXIS REIT stays exactly the same, that exact same pool of profit now has to be divided mathematically among 20% more shares. That is textbook equity dilution. It mathematically forces down the earnings per unit, which means it almost certainly dilutes the dividend per unit that you rely on.
I'd actually push back slightly on the inevitability of the dividend drop because there is an offsetting mechanic, though I'll admit it rarely balances perfectly. It is a classic corporate finance trade-off. Yes, you have 20% more shares requiring a dividend, but the cash from those shares pays down debt, which eliminates the interest expense on that debt. So the total profit pool does grow slightly because the interest expense shrinks.
But does it balance out?
The question is, does the savings from a 5% interest rate on retired debt offset the 20% equity dilution? Usually in the short term, no. You are asking the existing shareholder to accept immediate mathematical dilution today in exchange for a sturdier, de-risked balance sheet tomorrow. Placements might be a painful, necessary evil right now just to handle that short-term debt rollover without letting financing costs spiral out of control.
It's basically a necessary pay cut for the shareholder. But if we are talking about risks to the shareholder's actual yield, there is another layer of complexity here that frankly dwarfs the private placement. And this is a massive systemic red flag that we absolutely must highlight. We need to explain the tax cliff.
This is arguably the most critical systemic issue we will discuss today, and it isn't just affecting AXIS REIT, but the entire Malaysian REIT sector. To understand it, we need a brief history of REIT taxation in Malaysia. For years, the government provided a highly lucrative withholding tax concession for Malaysian REITs. This tax structure made the dividend distributions highly attractive, particularly for massive institutional and foreign investors.
The government basically incentivized foreign capital to flow into Malaysian real estate by offering them a really sweet tax deal. But that concession had an expiration date written into the law, didn't it?
It did. The concession officially expired on December 31st, 2025. And as of the release of this Q2 2026 report, sitting midway through 2026, there is still absolutely no official confirmation from the government regarding an extension or reinstatement of that concession.
Walk us through the mechanics of this tax cliff. What does the expiration actually mean for the math of an investor?
Without that specific concession, the tax reality for capital allocators changes dramatically. Non-resident corporate entities, meaning foreign institutional funds, now face a final withholding tax of 24% on their distributions. And non-resident individuals face a staggering 30% tax on chargeable income.
That's a huge haircut.
Think about the mechanics of this. If you are a massive foreign institutional fund managing billions of dollars and you bought AXIS REIT expecting a 6% yield, but suddenly the government is clawing back 24% of your dividend at the source, your actual realized yield plummets. The mathematical justification for holding the asset changes entirely.
This is a massive systemic risk. Because if a foreign fund manager sees their yield destroyed by a 24% withholding tax, they don't just hold the stock and complain, they reallocate.
Yeah.
They sell their Malaysian REITs and move that capital to Singapore or Australia, where the tax-adjusted yield is superior. If institutional money pulls back en masse because the yield is no longer tax-advantaged, it creates a vacuum of demand, which puts severe, sustained downward pressure on the unit price.
Absolutely.
And the scariest part, this is a purely external macroeconomic regulatory risk that AXIS REIT's management has absolutely zero control over. They cannot manage their way out of a national tax policy, but it directly impacts the net worth of every listener holding the stock.
It is a dark cloud over the entire sector. If we stop the deep dive right here, synthesizing the 6.5 moat, the operational friction, the 105 million ringgit Yong Nam lawsuit, the potential 20% equity dilution, and this looming unresolved tax cliff, it would paint an incredibly gloomy, bearish picture. But the market isn't entirely bearish because AXIS REIT isn't just playing defense. They aren't just hiding in the bunker trying to pay down debt and survive. They are actively going on a massive, aggressive shopping spree.
This is where the narrative sharply pivots, and we look toward the 2027 horizon. Despite the litany of challenges we just methodically outlined, the broader market and the institutional financial analysts covering AXIS REIT are actually highly optimistic about the company's near future. And that optimism is anchored entirely by a massive, ambitious acquisition and development pipeline that totals roughly 456 million ringgit.
Almost 500 million ringgit in new growth initiatives. That is exactly how management plans to repair the moat. If the old walls are crumbling from ground settlement and bankrupt tenants, you build massive new walls. Let's dissect a crown jewel of this expansion pipeline.
The crown jewel is definitely the proposed acquisition in Padang Meha, up in Kedah. They are deploying 113 million ringgit for a massive freehold industrial complex. We are talking about roughly 340,000 square feet of prime lettable area. And from an operational standpoint, why is this specific asset so attractive to them right now?
Because it completely neutralizes the exact risks they are suffering from in their current portfolio. It does not carry the vacancy risk that Bukit Raja has right now because it is being acquired fully tenanted. Furthermore, it comes structured with a 6-year master lease back to the vendor.
Let's explain the mechanics of a master lease for you listening, because it's essentially the holy grail of real estate stability. A master lease means one single corporate entity signs a contract to rent the entire facility, guaranteeing the rent for the entire space, regardless of whether they sublease it or use every square foot themselves. It completely insulates the REIT from vacancy fluctuations.
Exactly, and it gets better. This specific master lease includes a pre-agreed contractual step-up in rental rates during the second 3-year term. The initial gross yield on this property is targeted at a very healthy 6.6%, and the transaction is targeted for completion in Q1 of 2027.
This connects perfectly to their broader macroeconomic strategy. They are aggressively expanding their northern footprint in Malaysia. Kedah and Penang are becoming massive hubs for high-tech manufacturing and logistics. By deploying 113 million ringgit there and locking in a master lease with guaranteed step-up rent, they are buying absolute, mathematically predictable cash flow. They're essentially buying the exact opposite of the Yong Nam headache.
And Padang Meha is just the flagship. The pipeline is deep. They also have the Bandara Sojana Putra Distribution Center, a 128 million ringgit facility targeted for completion in Q4 2026. They have AXIS Facility 4 at Bukit Raja, a 38.8 million ringgit specialized manufacturing development targeted for the first half of 2027. When you aggregate all these incoming high-yield assets, you start to understand the analytical framework behind why analysts are telling investors to essentially look past the current gloom of 2026.
Let's look at those specific analyst targets because they are striking given the Q2 numbers. Both HLG and RHB maintain their absolute BY calls on AXIS. HLG actually raised their target price to MYR 2.37 and RHB raised theirs to MYR 2.44. Given that the stock has recently been hovering around the 1.90s, those analyst targets imply a very aggressive 20 to 25% upside for the unit price.
The institutional analysts are essentially establishing a narrative that 2026 is a sacrifice year. It is a necessary valley before a major structural peak. Their financial projections for 2027 are incredibly bullish. They forecast top-line revenue jumping to between 385 million and 392 million ringgit. They see realized net profit surging to between 220 million and 233.6 million ringgit.
But the metric that matters above all else to the listener holding the stock is the dividend. And the analysts are projecting that the DPU will bounce back strongly, hitting between 11.0 and 11.6 sen for the full year 2027. If you buy in at current prices, that implies a future dividend yield approaching 5.6 to 5.9%.
The overarching narrative from the street is crystal clear. If management can just execute on this 456 million ringgit pipeline, if they successfully lease up Bukit Raja and Shah Alam exactly as promised by January, and if the Wisma Kemajuan insurance check clears by the end of the year 2027, will be a blockbuster year that completely eclipses the operational friction of 2026.
I understand the math the analysts are using, but I have to aggressively push back on this rosy outlook. Are these analysts living in an alternate reality? I look at this narrative and I see a massive, almost naive assumption of perfect execution. They are pricing the stock based on a reality that does not exist yet. We are assuming that AXIS REIT can perfectly integrate 500 million ringgit of new, highly complex logistics assets while simultaneously trying to put out literal and legal fires in their existing legacy portfolio. They are actively struggling to release their current empty warehouses, but we are supposed to blindly trust that they can flawlessly manage this massive geographic expansion without a single hiccup.
That is a highly valid, critical challenge to the consensus view. The optimistic forecasts from HLG and RHB assume an environment devoid of friction. They assume no further macroeconomic shocks, no construction delays in the development pipeline, a seamless resolution of the tax cliff by the government, and a perfectly smooth recovery of occupancy.
Which rarely happens in the real world.
Right.
As we've discussed today, industrial real estate is fundamentally defined by friction. If there are permitting delays in completing Padang Meha, or if the new tenants moving into Bukit Raja suddenly demand excessive multi-million ringgit fit-out costs or lower starting rents to sign the lease, those bullish 2027 numbers will be revised downward by the analysts very, very quickly. The execution risk baked into that MYR 2.44 price target is exceptionally high. Which brings us perfectly to the synthesis of this deep dive. If we compress everything we've analyzed today, AX REIT in Q2 2026 is fundamentally a tale of two competing timelines. On one hand, you have the immediate, visceral short-term pain. The listener holding the stock today is actively feeling the pinch of lower quarterly dividends. They're carrying the anxiety of massive vacant distribution centers, the deep frustration of a 105 million ringgit legal victory being stonewalled by an insolvency liquidator, and the looming systemic uncertainty of a 20% equity dilution and the unresolved tax cliff.
And on the other hand, you have the compelling long-term promise. Management is deploying a massive, high-yield acquisition pipeline that specifically targets secure, master-leased assets to rebuild the revenue base. You have strong consensus analyst forecasts pointing to a major structural rebound in revenue and profitability once the current friction points are resolved in 2027. We formally downgraded their financial Moat score to a 6.5, acknowledging the severe current stress tests, but the underlying bedrock, the sheer scale, geographic dominance, and economic relevance of their 70 property industrial portfolio has not fundamentally crumbled.
It goes back to the commercial freight train. It's in the shop, the suspension work is incredibly expensive, the mechanics are arguing about the bill, and the passengers are naturally annoyed by the delay. But the engine itself still works, and once it's back on the main track next year, it is engineered to run incredibly efficiently. But before we wrap up this analysis, I want to leave you listening with a final provocative thought to mull over. Something that wasn't explicitly modeled in the analyst reports, but builds on everything we've unpacked today regarding the mechanics of real estate.
It concerns the underlying philosophy of scale and complexity.
Precisely. As massive REITs like AXIS REIT aggressively buy growth through these half-billion ringgit pipelines, constantly adding property after property to satisfy the market's demand for higher yields, they are now managing over 70 diverse, complex industrial assets. At what point does the sheer compounding complexity of managing 70-plus properties, dealing with 70 different aging roofs, 70 different geological ground settlement issues, hundreds of demanding corporate tenants, navigating liquidations, negotiating insurance claims on fires, at what point does that immense complexity fundamentally dilute the original simple value proposition of a REIT? A real estate investment trust was originally designed to be a relatively passive, steady income vehicle for the retail investor. But managing a sprawling multi-billion ringgit industrial empire is intensely active, highly complex, conflict-ridden work. Are these mega REITs becoming simply too big to manage perfectly without these constant dividend-eating operational hiccups? It's a structural question to think about as they chase that next $500 million in growth.
It is perhaps the most pertinent question for the future of the entire sector. Unchecked scale always introduces friction, and friction always costs money.
It absolutely does. Well, that brings us to the end of our analysis for today. I want to deliver a very warm, sincere thank you to you, the listener, for joining us on this complex financial journey. We know diving into the mechanics of insolvency law, NPI margin compression, and tax policy can be dense, but taking the time to truly understand the why and the how behind the numbers is exactly what separates a passive, vulnerable holder from an informed, resilient investor.
Thank you for investing your time with us today.
If you found this deep dive valuable, please gently tap that like button on the video. Comment below with your specific thoughts on AX REIT. Do you believe the hype of the 2027 analyst targets? Or are the tangible 2026 risks simply too high for your portfolio? And please tell us what other stocks you want the show to tear down and cover next. Finally, make sure to subscribe to the YouTube channel so you never miss a deep dive. Until next time, remember, even the best engineered freight trains need to go to the maintenance yard sometimes. It's just a matter of whether you trust the engineers to fix it before the cargo spoils. Take care.